and welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman. That is Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
We needed to slow the consumer down. I mean, that's where we were a couple of years ago when inflation was so hot, and the Federal Reserve took the steps to do it. At some point, you have to be careful what you wish for. And so this is an economy that is slowing. Leading indicators are pointing to further slowdown, and that's why we're starting to get the policy accommodations.
I think the Fed paved the way for more stimulus from the People's Bank of China to cut rates without worrying about the currency today. And this wide range of measures, you got multiple agencies involved, and a rare live press conference with a Q&A session indicates a sense of urgency by China to support the economy.
At this point right now, given both sides are not talking and they're very far off in terms of wages, in terms of discussion of automation, it seems likely that we will have a strike at this point. So my base case right now is there will be a strike. It's really a question of how long will that take place once it would begin.
We've got 1 hour to go until the market close, and we're taking a look at the major averages here. There's been a little bit of a push-pull today, and you kind of see that with the Dow, for example, hugging the unchanged line, bouncing around a little bit today. The thing that is pulling it downward, that's that push, I guess, rather than the pull upward, is consumer confidence data that came out this morning, showing the biggest drop in 3 years' time.
Yeah, and some of the demographics there were really interesting, Julie. Strategists were pointing out, if you looked at that key demo, 35 to 54-year-olds, you saw a decline back to levels we haven't seen since the depths of the COVID lockdowns. If you looked at income levels, that was kind of interesting too, and maybe not surprising given all the challenges for that group that we've talked about, but for those folks making under 50,000, stressed.
Yeah, and concern about jobs and whether jobs are easy to get right now. That said, we are seeing some of the other major averages hang on to gains. The S&P 500 up 0.1%. The Nasdaq up 0.4%. The other big story today coming out of China, just a big raft of stimulus being introduced there, kind of across different ways that it can pull levers there, including cutting types of rates, including stimulus for the housing market, and all of the ADRs, basically, for China. This is a look at a big basket of the different ADRs, Alibaba, PDD, JD, all of them, and I'm just going to equal weight it so you can see only a few were down today, but really broad-based rally in anything relating to China.
Neil Irwin over at Axios, I thought had a good point about this. As Neil pointed out, still the real issue for China remains the same, which is just this imbalance of overinvestment in real estate and heavy industry, underconsumption by the consumer. I think Neil was asking a good question, is whether these actions, these measures, do they really get at, delivering an answer for those core foundational problems? We have a smart strategist come up later to talk through it.
Yes, we're going to talk more about it, but I do want to point out it is not just direct China companies here. For example, we also have commodities that are rallying quite a bit today because some of them have been under pressure because of concern about lack of demand from China. We're going to get into this more today as well. But not only are you seeing things like oil go higher, you're seeing copper also catch a bid today. And then finally, one other thing I want to point out is what we're seeing in terms of the groups in the S&P 500. And the group that is doing the worst today is the financials. We have some of the financials under pressure, including Visa, which has just been sued by the U.S. government. We're going to get into the details on that later. Global Payments making some comments at a conference today that's pulling that down. So this is all the financials, but it's really sort of the payment sector that is pulling things down.
And we have a strategist who has thoughts about the financials. You can talk to him right now. For more on the latest market moves, we want to welcome in Skylar Winan, Regan Capital Chief Investment Officer. Skylar, it is good to see you. So, just talking to Julie there, different cross currents today, Skylar. Consumer confidence disappoints. Of course, the news out of China. I think got to mention geopolitics as well. U.S. sending more troops to the Middle East. Skylar, but tell us what's front and center for you.
Well, the bazooka, obviously, from Fed lowering interest rate 50 bips, but also Waller, Bostic, some of the big Fed governors coming out and saying there's a lot more to go in terms of interest rate drops. And you just talked a little bit about the financials performing the worst today. It's kind of counterintuitive, but these big Fed drops actually hurt these banks in the short term. Okay, they were investing at 5.25 a week ago. Now they have to put their new cash or that fresh cash to work at 4.5, 4.75, if not lower, which is where front end bills are. So in the short term, financials get hurt because they're not earning as much on their cash and they're not able to lower their deposits that quickly. Yet they still have these loans and investments out there that are still only earning 2 to 4%.
When does that start to turn, Skylar?
People have been talking about the curve de-inverting. Well, that's only 2-year to 10-year, okay? Whereas the front end of the curve, 1 month, 3-month bills, where deposits go, CD, overnight repo, that needs to come down a lot more, a couple hundred basis points to like 3%, which is where they're scheduled to go in a year from now. Whereas a lot of these banks are still lending in 30-year mortgages or in 5-year balloon loans to multifamily real estate and commercial at like 4 to 4.5%. So that front end needs to get below 4 real quick before these banks are in the black in terms of where they've already lent money versus where they're borrowing money.
What about, Skylar's other big news today? China's central bank taking action here, these measures to try to support that economy. I just get your analysis of that, Skylar. Does that get you excited about owning Chinese equities?
Stimulus is great. Stimulus is great for the market, no matter whether it's coming from China or the US, whether it's coming from lower interest rates or stimulus. Whether Kamala or Trump get elected, we're going to see further stimulus vis-a-vis deficits in the next few years. All that adds up into the market continuing to roll along, okay? And that's broadly speaking worldwide. And I think the end goal here on the China front is to keep the economy humming and keep the populace not protesting, not coming into the streets, not worried about losing their jobs, not worrying about the unemployment situation. And the Fed's in a very similar boat, okay? They need to keep unemployment at 3.5 to 4% here, not let it get above 5. Otherwise, people are going to start to, get mad and start protesting. And so that's what the Fed's worried about. That's what China's worried about. In this stimulus, whether it's coming from lower interest rates or pumping the economy with money, are going to keep the market rolling.
And Skylar, as our Josh Schaefer wrote about in this morning's Morning Brief newsletter, we're seeing some more 6 handles for the S&P 500 in terms of year-end targets, which sort of makes sense given the pace that we have seen thus far. Are we back to not fighting the Fed? Is it time to trot that out again?
I think that's true on the equity side. When you're talking about what's actually going to really be helped from, call it 3% interest rates, we're already at 3.5% across the board. You can still get about 4.75 on the front end, but 2s out to 30s are 3 handle. 2s to 10s are, call it 3.5 to 3.75 right now. So you're not getting compensated really for generic fixed income. That's boosting stock market values. To say we're going to go up another 5 to 10% between now and the end of the year is hard. Maybe over the next 12 to 15 months, sure.
Scott, I was going to ask you about the election, but and granted, we're only weeks away here from the big day, but do you believe, is the market even focused on that right now, Skylar?
No. I think the market sees them in one and the same. If Harris gets elected, maybe that affects taxes. If Trump gets elected, maybe that affects, the currency situation between us and Europe or us and China, whether or when or where tariffs get put down. But the market really looks at them as one and the same. They're both going to be stimulative. They're both going to run deficits. And, so we're going to have to wait and see. I think what is going to turn the tables one way or the other is if there's a sweep. So if you have a Democratic president and both houses of Congress or vice versa, then we're going to have some microscopes on how is this really going to affect the market. But the jury's out on that sweep happening. We'll see.
We will. We got to wait. Skylar, thank you so much. Appreciate it.
Thank you.
We're just getting started here on Market Domination. Coming up, China e-commerce giants seeing a stock surge today after a stimulus package announcement. We'll tell you more about it on the other side. Plus, the East and Gulf Coast ports bracing for a dock workers strike. What could that mean for your grocery list and holiday shopping? We'll tell you later in the hour. And big names running up that Capitol Hill today. Haha. We're checking in on the latest from SEC Chairman Gary Gensler and Novo Nordisk CEO Lars Jorgensen. Stay tuned. All that and more when Market Domination returns. China stocks like Alibaba, JD.com, PDD, NIO, XPeng, they're all trending in today's session. Shares of those Chinese companies surging after China unveiled a stimulus boost for its struggling economy. The package of measures, including funding to boost the stock market and aid share buybacks. Anthony Sassine, CraneShares senior investment strategist, joins us now to discuss. And as we're going to talk about more in just a few, Anthony, it's not just direct China stocks. There are a lot of implications for the global economy as well. People have been waiting for this. But is this enough? Is this what the Chinese economy needs?
I mean, this is a great step in the right direction. We've been waiting for this for many months. We talked a lot about bazooka approach because we kind of thought that the economy needed a big push. And we got something similar today that we can call maybe a mini bazooka, where you kind of see rates cut across the board from repo, 14, 21, 7 days, also mortgages, and also to the required reserve ratios as well. So this kind of tells you that the Chinese government is really looking to boost growth here before year end. And you can see that there's a little bit of panic. And usually when, the saying says, when the Fed panics, you buy stocks. And this is what we're seeing today with China. And we're seeing China Internet leading the way, because we always said, with clients and previous appearances that the main mechanism of consumption is the Internet names, and these names are going to benefit the most from any recovery in China.
Can I ask you, Anthony, would you also expect to see more aggressive fiscal stimulus as well?
Look, I think China's going to roll out more stimulus in the next month as well. The Fed chief Pan Gongcheng mentioned that there's another rate cut coming. What we want to see happen as well, in addition to this, is demand stimulus type, right? Like sending money directly to consumers, or some kind of a transfer of economic gains from industries and manufacturing to consumption, to just help the consumer recover. Because I think that's what's going to take the recovery for the long term, to make it more sustainable. We should see a recovery in revenue growth that it's been in single digit for the past year or two, held in single digit. That's because of lack of demand, because of low consumption, and because of real estate, of course.
So for investors who have been waiting on China, who have been cautious, who haven't wanted to get involved there because of risk of regulation, risk that the economy was not going to rebound, is this the signal that they should be getting in? Is this a sustained signal beyond just the pop that we're seeing today?
This is a very good signal, right? Like that the government is looking finally to make a big impact. But as I mentioned, we need to see now. You're going to see a pop here. You're going to see KWeb and some of these companies, up 10% today, probably good momentum, upward momentum for the next few months. But investors are going to be looking at earnings, right, which are going to be coming up soon. There's also the Singles Day in November, which is also going to be very telling to see if the consumer is responding, if we're going to see that rally continues, right? And these events are going to be key.
Anthony, there may be some investors listening right now who've been hesitant to move into Chinese equities, in part because of geopolitical tensions running hot between the U.S. and China. There are Republicans and Democrats who see China as a U.S. adversary. It may be the one issue, in fact, a lot of Republicans and Democrats agree on. How do you address that dynamic?
It's certainly an issue, right, that we see. It's certainly a risk that we're monitoring. But, we think that the two countries are very interrelated, and especially for the long term. These are the two biggest economies, the two biggest trade partners. So at some point, these are going to be resolved. And two, China's impact, these policies' impact on China's earnings have been minimal, right? Because none of these companies do business in the U.S. until now. Alibaba, Tencent, very minimal. Maybe now with Pinduoduo, Temu, maybe is a little bit more popular in the U.S. But for the most part, most of the KWeb names, most of the EV names, they don't do any business in the U.S. I don't think they were planning on doing any business anytime soon. So this is a little bit overblown. But one thing you can notice, and the downside in these names have been limited, right? So we've been bouncing on 25 for KWeb for the past 2 years now. And, so the downside is limited because really everything bad news here is priced in. I don't see any more downside except for something extraordinary happening. So you're only left with the upside here when policy starts targeting consumption, and when you start seeing the recovery of consumption and recovery in earnings, especially revenue growth. You're going to see, the Chinese equities react positively here, especially because of the very low valuation, very low positioning. These stocks have been beaten down massively over the past 2 years.
As you said, the sort of internet stocks in KWeb, which you guys manage, is, that they've been particularly sensitive to all of this talk about stimulus. What about outside of that? Are we going to see, as you say, it's going to filter through to the consumer, filter through to manufacturing and housing? So would you sort of see sort of a delayed effect with some of these other industries?
Absolutely. That's gonna affect all industries across the board, right? We're making money cheaper, and also we're lowering mortgage rates, which is very much related to real estate. So basically, hopefully, consumer is going to start buying, and that's across the board. But then these names are most sensitive because they're the engine of growth in China, and they've been beaten down the most, starting with once China started regulating this sector 2, 3 years ago. Now it's trying to uplift it. Actually, they're trying to support it because they realize that this is if they want to solve youth unemployment, if they want to bring growth back, if they want to see innovation, especially with regards to AI and cloud and all these future industries, these are the companies that will be leading the way. So basically, that's why they are more sensitive, because of their status. But this is going to trickle down across the board. That's why we'll also like the A shares, right, which is domestically listed companies on Shenzhen and Shanghai. And these are different names in different industries like consumer staples, like renewable energy, like manufacturing, high-end manufacturing, semiconductors, robotics, all included in the A-share market. So we like both, but we think KWEB has more upside to go.
Anthony, thanks as always for joining the show. Appreciate your time.
Thank you so much.
Over in the commodity space, oil climbing as traders digest China's biggest stimulus package since the early days of the pandemic. Yahoo Finance's Inez Frey joins us now with a closer look. Inez.
Yeah, Josh, and if we take a look at WTI and Brent today, up almost 2%. In fact, this bump that we saw today for U.S. crude has put crude into positive territory year to date. And we are seeing Brent crude also higher. All of this really because of that China stimulus package that you just mentioned. I was talking to one analyst that was saying it's because of that, because all year long we have been really talking about lower demand from China, and so he's basically saying the fact that you have this stimulus has really bumped up the price of crude. You also do have geopolitical tensions that has kept crude volatile over the last several weeks, but still, nevertheless, it's mostly China. I do want to note that Brent is now above $75 per barrel. This is around the range that some Wall Street analysts have been looking at for the fourth quarter of this year. We will have to see where it goes from here, though, because last week we saw oil jumping up more than 4%. We'll see where it goes in the fourth quarter because we do have OPEC Plus that is scheduled to bring some barrels back into the market starting in December. We'll see if they follow through with that or not, guys.
And it's not just in the oil energy complex, right? We're seeing it in commodities like metals that are higher today.
Hugely, because we are looking at metals being industrial metals that are higher. Of course, you have the usual plays of the gold with highs. Silver seeing big highs today, up more than 4%. Remember that silver is also used as an industrial metal too. You have to really go back more than 10 years. Look around 2012 to see the same type of level that we're looking at for silver futures, up above $32 per ounce. And then we're also taking a look at copper that is up as well today. But look, copper had been on an upward trend. I'm just going to pull up a 2-month chart here, or maybe a 3-month chart, so you can see we had seen some deflationary pressures when it comes to copper and some of the other metals, and then we started seeing it bump a little higher, and we have been seeing it up. In fact, copper up about 10 days now straight in a row. Same situation that you're looking at for some of the other industrial metals as well. And I do want to point out that some of the big performers today as well have been the miners. So the miners have been seeing some gains today, along with the metals, guys.
Inez, thank you so much. Appreciate it.
Thank you.
Coming up, roughly 45,000 workers at ports across the East and Gulf Coast are set to strike next week. But what does that mean for the everyday consumer? We'll break down the impacts on the other side when market domination returns.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World. For a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline, because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
The East and Gulf Coast ports bracing for a dock workers strike, and there could be major implications for the U.S. economy and for consumers, especially when it comes to inflation. Roughly 45,000 dock workers at every major Eastern and Gulf Coast port could walk off the job. The affected ports range from Houston, Texas, all the way up to Maine. And more than half of all goods shipped in containers to and from the U.S. go through these ports. Some key sectors that have more than half of imports and exports going through these ports: pharmaceuticals, vehicles, air and spacecraft. That's all according to the National Association of Manufacturers. A strike would also affect clothing, shoes, and more heading into the holiday shopping season. Just over half of imported apparel, footwear, and accessories come through those East Coast ports. The last time there was a strike across the gateways, by the way, was in 1977, and that did affect retailers ahead of the holidays. Also, your grocery trip could get more expensive, even risking empty shelves. 2/3 of all bananas are unloaded at East and Gulf Coast ports, and a major share of orange juice imports go through a facility in Newark, New Jersey. Overall, according to one estimate from Oxford Economics, a week-long strike could impose a $4.5 billion to $7.5 billion hit to the U.S. economy. Josh?
Thank you, Julie. With the major port strike in the U.S. drawing closer and over half of U.S. imports and exports facing the threat of supply disruptions, we're taking a closer look at the ramifications with Flexport founder and CEO Ryan Peterson. Ryan, it is good to see you. Maybe start at a high level, Ryan. So this possible port strike on the East Coast, Gulf of Mexico, walk us through the potential consequences here, Ryan. What kind of impact would you perhaps expect to see?
Yeah, hey, great. Thanks for having me on. I think it really just depends on how long it lasts. If it just lasts for a day or two, it's probably not a huge deal. It's also happens to be that next week, when this would kick in, if it does go down, is the what's called the Golden Week holiday, when all of China's factories are shut down. And so that's probably a happy coincidence that there's not a lot of activity anyways at the origin side of things, of cargo moving out. But if it lasts for more than a few days or more than a week, you're going to get massive cascading effects of backlog building up of cargo that needs to get moved and can't. And you're talking about 15% of the world's container ships being taken offline. That's the percent that call at these ports every year. That's a huge reduction in capacity. You just saw some of those statistics. I think the longer it lasts, the more that cargo buildup, that backlog will build up. And the prices will go crazy, sky high. You'll see supply chain disruptions of the type that we saw during COVID, but actually probably much worse. That in the COVID instance, those were caused by a huge increase in demand for goods. This is really different. This is a decrease in supply, much worse from an economic impact standpoint.
Ryan, weren't we supposed to fix all this stuff, right, during the pandemic? Wasn't Flexport supposed to help fix all this stuff, right? I just remember having these conversations about how part of the issue was, at least, how antiquated these systems were of tracking goods, of figuring out how to get things where they're really needed. So has there been some progress made since then? Are we more nimble at all in terms of dealing with this kind of stuff?
Well, I mean, it sounds like you're trying to blame me, so that's a little unfair here.
No.
No, the reality is, look, the union is a very powerful force. They do a lot of great work. They work really hard. They deserve to get paid, but it's a fundamental dichotomy here between the employers, and in many cases, the brands, the companies that rely on these ports, and the union. The employers want automation. They want to lower costs. They want to reduce the number of workers. For obvious reasons, that's not what the union wants. And so you're at a bit of a standstill. There's the main issues here is one is how much are they going to get paid? That's always a negotiation, always a challenge. But the automation one is the really sticky one. These ports in many other countries are fully automated. They don't need the workers, and the union sees that. They know it. They know the writing's on the wall. They gotta stand up for their jobs. That is their job as union leaders. And so these contracts tend to run for about 6 years. It's going to be the battle every 6 years for the rest of their lives. There's not like technology is going away. So the technology exists and it's there, but for obvious reasons, this union just will not want to see it happen.
Ryan, let me ask you, some viewers might be watching this and thinking, well, if there was a potential strike, East Coast, Gulf of Mexico, why can't they just divert more to the West Coast? Why isn't it that simple?
A lot of reasons. You saw in those statistics that 56% of the containers come into the East Coast. Well, the West Coast can't handle that much more volume. The ports will just not be able to handle it. There aren't enough ships calling at the West Coast in the first place. The cranes won't be able to unload that many. The yards will get bottlenecked. Won't have enough trucks, enough trailers with chassis, as they're called in the industry, to haul those containers. Just simply don't have the capacity to do it. Similarly, people think, well, we'll just switch to air freight. One container ship would probably be enough to fill up all the world's air cargo planes, like the one behind me. You just won't be able to pull it off. So at the end of the day, this will just create a massive backlog of cargo sitting offshore, yes, but also the longer it lasts, the more you see that backlog building up at origins around the world. And then where it really gets bad is when these ships that are supposed to call in the East Coast, after they unload their cargo, they're supposed to continue on their journey back to Asia or back to Europe, wherever they may be going, and pick up more cargo. Well, if they're sitting there waiting in the East Coast, they're not continuing that journey. So you wait another month and they're not where they're supposed to be. And cargo is going to start building up in all these other parts of the world. And that's why you'll see this cascading effect as the bottleneck that's caused by this just ripples through the world's supply chain and causes very unpredictable outcomes.
Ryan, got to leave it there, unfortunately. Thank you so much. Appreciate it.
Yeah, my pleasure.
Time now for a call of the day, sponsored by Tasty Trades, shares of Starbucks. We're watching those following a rare underperform call. Jefferies lowering its rating on the coffee giant, saying a turnaround under new CEO Brian Niccol is going to take more time. Joining us now is the analyst behind that call. It's Jefferies Managing Director Andy Barish. Andy, thanks so much for being here. Man, everybody has been super pumped about Starbucks and that new CEO appointment. And you're stepping here to say, okay, hold on a second. He is a talented individual, but he is not a miracle worker, at least not instantly here. So Andy, talk to us about the biggest challenges you think Niccol has to face here.
Yeah, thanks, Julie. Yeah, there is no magic bullet here. I think, we do respect Brian quite a lot. And obviously the analog from Chipotle when he joined in 2018 has been thought about and thrown around, but this is a much larger, complicated, global, business that we think kind of needs a reset from a culture, people, and operations perspective, and that's a lot, and that's going to involve having to really, I think, build out the team, and we've already seen some changes, like Mike Conley announcing he's going to be leaving Starbucks before year end, and I wouldn't be surprised to see others. So first, the team has to come in with Brian, and then start to stabilize the people and operational side of things, and then I think you can start to paint the path to what the rest of this turnaround might look like as we move forward.
I'm interested, Andy, just as someone who knows the company so well, what kind of customer experience do they want to build at Starbucks? As a Starbucks fan myself, is it the kind of place ultimately where, Josh should be expected to go get a coffee, relax for a while, listen to a podcast, or no, it's an assembly line, get Josh in and out?
Yeah, Josh, I think that's a real interesting strategic debate that's probably been going on at the board level and I think Brian has come in, and at least in his initial communique, you know, kind of the day after he joined or 2 weeks or so ago, really did kind of emphasize that he still wants it to be that community gathering or third place. They just need to make the partner experience better, which will then improve the guest experience. And I agree with that, but I think there also is a healthy balance where they do have demand in the morning day part still. That's obviously the biggest, most important part of their business. Yet there are some challenges with speed and throughput and all the different channels with technology that I think need to be figured out to sort of unlock some sales in that very important part of the day.
And Andy, you say bottom line, the company's earnings per share growth at the size it's at with some of these challenges you're discussing is just not going to be consistently what it was historically. What are your expectations and how do they differ, do you think, from what your peers on the street are expecting?
Yeah, the long-term growth algo, which was kind of set at a pretty high level a couple of years ago, involves 7% global unit growth, and that's primarily about 1,000 units a year in China and 500 in the US, along with some other international markets. And then mid-single digit same-store sales, progressive margin expansion, getting to 15% plus earnings growth. And we just think starting out that 7% global unit growth in both those key markets that I noted just runs counter to the ability to get an operational turnaround established and underway. It just puts a lot more pressure on the organization. So we think it would behoove Brian and the company to slow down the unit growth, not shoot for mid-single digit same-store sales, but maybe low single digits would be an achievable and maybe beatable target at some point. And that kind of gets you to low double-digit earnings growth, which, you know, for a company of this size is certainly still very admirable, but also in line with a lot of the other global QSRs, not a big premium growth rate that we've seen Starbucks grow at historically.
Andy, great to have you on the show. Thanks for joining us today.
Thank you.
Coming up, Novo Nordisk CEO Lars Jorgensen testifying before Senate today amid weight loss drug pricing. Would get you the latest on the other side when market domination returns. It's a big day on Capitol Hill. Securities and Exchange Commission Chair Gary Gensler testifying before Congress regarding his crypto crackdown. We've also got the Novo Nordisk CEO on the hot seat, facing a Senate grilling over the high prices of the company's weight loss drugs. We got full team coverage here with Yahoo Finance's Jennifer Schonberger and Anjali Kamlani. Jennifer, what did we hear, starting with you, from SEC Chair Gary Gensler?
Josh, divisions within the SEC on regulating crypto to capital formation were on full display during a House Financial Services Committee on oversight of the agency, with lawmakers pitting SEC Chair Gary Gensler against Republican commissioners. Committee Chair Patrick McHenry probed Chair Gensler and the commissioners on a lack of clarity when it comes to regulating crypto. When asked whether the reason multiple terms are being used to define crypto is that there's no regulatory consensus on which tokens are securities, Republican SEC Commissioner Hester Peirce said she thinks it's true that the SEC has taken a legally imprecise view to mask the regulatory lack of clarity.
What's happening is that we're trying to be ambiguous because the legal precision carries with it real implications. And this is why people have been coming to us and saying we need clarity. We've fallen down on our duty as a regulator not to be precise.
Gensler was slammed by Republicans, McHenry calling the agency rogue under SEC Chair Gary Gensler's watch. At the same time, Republican Representative Pete Sessions said that the SEC lacks fairness and balance and that it is engaged in selective enforcement action.
Under Chair Gensler, the SEC has become a rogue agency. It routinely exploits its authority to the detriment of our capital markets, innovation, and the American people. Chair Gensler recently said, quote, "We at the SEC live within the laws as Congress passes them," close quote. Unfortunately, nothing could be further from the truth.
Meanwhile, Ranking Member Maxine Waters asked McHenry publicly to pass legislation to regulate stablecoins by the end of this year, something she said she strongly believes can be achieved. Waters saying to McHenry, quote, "I've made a public statement of bipartisanship. What are you going to do with it?" McHenry telling her, quote, "It is my hope we can come to terms on stablecoins as well as offer clarity on crypto assets in general." Back to you.
Thanks a lot, Jennifer. Appreciate it. And now let's get to the other big event on the Hill here. Anjali, we've got that other big name in focus on Capitol Hill today. That is the Novo Nordisk CEO defending the prices of his company's obesity and type 2 diabetes medicines. What can you tell us about some of the exchanges and what came out of it?
Well, it definitely started out as a heated debate, as expected, with Senator Sanders, of course, leading the Senate Health Committee. And we got a little bit more insight into just how Novo Nordisk is kind of operating globally. And that's sort of the crux of what the issue was, looking at how the prices of these same drugs, Ozempic, the type 2 diabetes drug, and Wegovy, the weight loss drug, are priced in European countries, for example, under $100, in Australia as well. And when pressed by Senator Sanders, CEO Lars Jorgensen did manage to sort of skirt the issue in the beginning. But then towards the very end, Senator Mike Braun from Indiana pushed on the issue, asking about those sub 100 prices. And here's what we got out of that.
Are you making a profit on your Ozempic product when you're selling it to Australia for $87 and you're selling it to the US for $936? Are you making a profit at $87?
Yes, we are. And the price you mentioned in the US is not what we get.
Of course, that's another part of the issue. The list price for the drugs is not what the company is getting. In fact, we know that PBMs ask for rebates. And in the process, we also learned that Novo Nordisk estimates that about 74 cents for every dollar collected on these drugs actually goes to those PBMs. So a lot of contention, and then focus pivoted to sort of blaming the PBMs, which is sort of what the entire hearing turned into, especially because the Senate Health Committee has been looking at a way to shape how PBMs operate and shift it away from this black box and into an idea of a sort of transparent, a flat fee situation where every drug just simply gets a flat fee for formulary. As in terms of outcomes, we did see that Novo Nordisk CEO committed to working with the committee on being able to maybe work on a price with the PBMs. And then in exchange, Senator Sanders said that he got written commitment from the PBMs that they would not then kick off the drugs from the formulary or lower them in terms of preferable location. Of course, with the amount of brand recognition they already have, that might not even be an issue. But as you also just saw on your screen, this hearing didn't seem to do much to hurt Novo's outlook in terms of the stock right now. So it seems like maybe there isn't too much punch when it comes to what the hearing achieved, but certainly a lot going on when it came to sort of information.
Anj, thanks so much. Appreciate it. Well, between reports of a possible takeover of Intel by Qualcomm and the launch of Apple's iPhone 16, it has been a busy few days for the tech industry. With just a few minutes left until that closing bell on Wall Street, we're looking at how to play big tech stocks with the Yahoo Finance Playbook. And joining us now is Angelo Zeno, CFRA Research Senior Equity Analyst. Angelo, always good to see you. Let's start with a name you know very well, Angelo. That's Intel. Did make some news today, unveiling a pair of AI chips, Angelo, so looking to improve that data center business, compete harder and better with NVIDIA and AMD. What'd you make of that news?
I mean, nothing much really. You've got a new CPU, a new kind of Gaudi 3 accelerator out there, and Intel will continue to roll out new capabilities, new chipsets out there in the foreseeable future. But that said, I mean, I don't think it necessarily changes anything as far as the Intel story is concerned. That's the fact that this is a company that continues to see its business model under attack, right? I mean, whether it be kind of to competitors like an AMD, which has kind of been eating market share from Intel here over the last couple of years on the PC and the data center side of things, or whether it be kind of NVIDIA as they ramp their Blackwell offering here, potentially taking some share on the CPU side of things, as Blackwell is kind of more of this kind of platform-based offering, or even kind of some of these kind of custom design chips now, when you kind of think about the Alphabets of the world kind of ramping up Axiom, or even Amazon Web Services with kind of their Graviton chip out there. When you kind of look at the CPU industry, it looks like it's really kind of under attack right now as far as where Intel stands at this moment in time.
Angelo, if you are an Intel shareholder, or if you're interested in becoming one, what is the best case scenario for Intel right now? And does a best case scenario that does not involve being acquired or getting outside funding exist?
That's a great question. So as far as kind of the best case scenario for investors out there, listen, I think a potential acquisition would be somewhat enticing if the right company came out there. I don't think that company would be Qualcomm, to be honest with you. I think there's only kind of limited upside in terms of what they could offer out there. Not to mention, I think from a regulatory perspective, I don't think the deal kind of gets anywhere near to being completed. So you kind of look at where book value for Intel kind of stands around, let's call it about $25 or so. It's very difficult for Qualcomm, especially given the amount of debt that they'd have to take on and the amount of equity they'd have to issue to really kind of be a realistic acquirer, unless Intel stock were to significantly decline from these levels. If you are an Intel investor out there, I think maybe the best situation out there at this point in time is hoping Intel can kind of significantly cut OpEx costs here over the next couple of quarters, in return to positive free cash flow, and then kind of hope they start seeing some sort of momentum on kind of the foundry side of things in terms of kind of gaining some traction from external customers out there. The hope is maybe that partnership or extended partnership they signed with Amazon Web Services will help them gain some momentum here over the next couple of quarters. But that really is the hope at this point in time. If you're an Intel investor, you're essentially a value stock at this point in time, hoping for improved profitability metrics to kind of get the stock going a little bit.
Angelo, just switching gears here, another theme you've written about is how big tech, of course, spending a lot on AI, and how you expect that to continue, Angelo, despite what you call meager AI monetization. Why do you expect that to continue, Angelo, and what are some names that would benefit from that trend?
Yeah, I think that's kind of an important question right now. Probably the biggest question we get is how sustainable is kind of some of the trends that we've seen right now in terms of CapEx spending. from kind of the mega cap providers out there, but not only from the mega cap providers, but also some of these tier 2 cloud providers, as well as some of the enterprise customers out there. Our view right now is that as far as kind of the mega cap tech companies out there is concerned, they will continue to spend as long as kind of their business models, their revenue trajectory continues to hold up. And we think that will be the case in terms of cloud spend and in terms of digital ad spend going into 2025. And also kind of the compute trajectory here over the next decade, right? If you're a believer that kind of what Jensen has recently said here, and that is the fact that the compute can kind of increase by up to 1 million-fold here over the next decade. The fact that improving compute metrics over the next couple of years will potentially drive greater AI monetization, new use cases for AI, I think is a very interesting proposition and a reason why these hyperscalers will need to continue to aggressively invest. So for that reason, we continue to think there is stabilization past 2025. And that really is the key, I think, right now for investors. If they have greater conviction on 2026, I think you'll see kind of improved dynamics for the broader semiconductor industry. And the names we do like the most continue to be some of the names that worked here over the last kind of 12 to 18 months. NVIDIA, a name like Micron, which has pulled back significantly and reports tomorrow on the memory side of things, Marvell, AMD, as well as Broadcom.
Yeah, those Micron numbers going to be very interesting. Angelo, great to catch up with you as always. Thank you.
Great. Thanks for having me.
The U.S. Justice Department is suing Visa, alleging the global payments giant illegally monopolized the debit card market. Yahoo Finance's Alexis Keenan is here with more. And Alexis, this investigation has been going on for a long time. Visa's been under scrutiny. So what finally is the government saying?
So this involves the whole debit card market, and they're saying that Visa is holding on to its monopoly illegally using tactics that they shouldn't. What they say is that they're maintaining this monopoly by charging merchants who choose not to use their network for processing a higher fee. So the Visa owns kind of the railroads, the highways that process these transactions. And unless the merchant chooses through communication, so there's contracts that Visa has with the major banks, and the DOJ is saying, well, these contracts are making the merchants either choose Visa or face those fees that are higher. So every time there's a swipe, it's already, right, an expensive transaction for a lot of merchants to have to pay that fee that comes out of that percentage of sale transaction. And this is what the DOJ doesn't like. Now, Visa is a duopoly with MasterCard. It processes in the US more than 60% of these debit card transactions. And for its part, the company has issued us a statement. They say, look, anybody who has bought something online or checked out at a store, that they know that there is this ever-expanding universe of companies offering new ways to pay for goods and services. They say today's lawsuit ignores the reality that Visa is just one of these many competitors in a debt space that's growing with entrants who are thriving. So who are those rivals? Well, companies like Apple with Apple Pay, Block, formerly known as Square, PayPal, Cash App. These are the kinds of companies that they're saying
But in
they're
a lot of
competing
those
with.
cases, like when I pay with Apple Pay, I'm still paying with my Visa, but I'm doing it through Apple Pay.
Right.
So like in many cases, you're still linked, right? I don't know about you, Josh, but like I'm still linking my Visa card to that, through that
Right,
other
but
stuff.
some of these transactions are directly from bank to the vendor. So they're not getting the same type of benefit that they would be going through these other networks. So Visa, for its part, saying, well, these are our rivals and this is a growing space. And they say that this lawsuit is meritless coming from the Biden administration.
So what happens next, Alexis? What's the next step in the process here?
Yeah, so they're going to have to respond to this complaint no matter what. And of course, we have an election coming up. So that means a change in administration, no matter which way you slice it. We don't know what a Harris administration or a Trump administration would do with this kind of case. Certainly, President Trump had brought a case against Google. And so we don't know if this would continue on. But as Julie said at the beginning here, these Visa and MasterCard, for its part too, have been in litigation for decades over these types of fees and various concerns about the transactions.
All right, more to come. Alexis, thank you so much. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street, and now it's Market Domination Overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session here, because it was kind of a little bit of a bouncer around, especially for the Dow. Looks like it's finishing higher by about 84 points, about a fifth of 1% when all was said and done. As we talked about today, sort of push and pull here. Initially, stocks getting a lift after that big news on broad China stimulus, that news crossing overnight. And then we saw a little bit of a come down, right, kind of around 10 a.m., although we went up and down again after we got consumer confidence numbers that fell the most in 3 years' time. But major averages pretty much recovering here. The S&P 500 closing higher by 0.25%. The Nasdaq up by about 0.5%. And by the way, as I say this, I believe that now we have another record close for the S&P 500. So that's something to note as well. And of course, as we talked about earlier, across assets, we saw some other rallies that we should note as well. It was kind of a risk-on day. Bitcoin higher. We also saw crude oil rising on the day on that China stimulus as well. And we saw technology perform pretty well. As you just saw, the Nasdaq Composite was the best performer of the three major averages. Some notable exceptions to that: Microsoft getting a downgrade today, so those shares down about 1%. Nvidia, though, up about 4% here. Nothing in particular necessarily driving these gains, no big headlines, but catching a bid there. And we're seeing some of the other chip makers behave well. Broadcom is on that list as well. Sector-wise, again, reflecting the enthusiasm over China stimulus. We saw materials doing the best in today's session, and financials weakening here, among them Visa, on that news that we just talked about, the Department of Justice suing the payments platform, alleging unfair monopoly practices. We're going to keep watching, of course, that developing story. Josh?
All right, Julie, modest gains on Wall Street, but it's enough for new records for the Dow and S&P 500. And joining us now is Dryden Pence, Pence Capital Management CIO. Dryden, always good to see you, sir.
Happy to be here.
So listen, Julie was just pointing out some green on the screen today. A couple of interesting storylines. Disappointing consumer confidence, the news out of China. Give me your take on this market, just where we are and where you think we're headed.
Well, I think in general, we think the market is going to continue to do fine. And part of it is record earnings turn into record markets. And you've got record earnings and record profits, both here for 2024 and for 2025. And this consumer confidence piece that came up is, I think, as you dig into it, it really was more about the softest part of the soft landing. And so people making under $50,000, people in the 25 to 35, their consumer confidence has kind of come back because I think it's a relative movement. As we've said before, the economy's been moving at 90 miles an hour. We're slowing down to 50. It feels like you're standing still, but you're really moving 5 times faster than you can normally walk. And so while emotional reality and economic reality can sometimes be two different things. And I think we're seeing that with part of the consumer, seeing part of that with sentiment. But I think that the fundamentals are still awfully darn good. And we're moving into a rate lowering environment, which ought to be accretive to earnings, and that's what's driving the market.
I want to linger, though, on confidence for just a second here, because one of the components of that consumer confidence is how people are viewing the job market. And one of the measures that Wells Fargo highlighted was the jobs plentiful minus jobs hard to get, and how people are perceiving that gap. And it's going down, which sort of usually presages the labor market getting worse.
Well, we had this moment where, a year or so ago, we were looking at 2 jobs for every person looking, right? And so now the job market has come back into more balance. And I think that's one of the things that's allowing the Fed to do some of the movement that they're doing, because they don't want to get in these rage spirals and these real peaks. So as certain markets are saying jobs aren't quite as plentiful as they were, and it's a little bit harder. That means that we're moving to a balanced job market. And I think that that's important because if you look, again, you got to break it aggregately. We got more people working more money, making more money than ever before, right? But, where you are as an individual, you might make it not quite so plentiful. So it makes sense that people would say, hey, jobs aren't, I don't have 4 job offers, right? I only have 2 or I only have 1. Well, maybe take the 1, but it's still a job.
Right. Let me ask you, Brian, obviously the Fed is more focused on that moderating labor market. What do you think the trajectory of cuts looks like from here?
I think I think the Fed probably wished they would have gone in July.
You think it was a catch-up cut?
Yeah, this is a catch-up. This isn't about the economy going bad or anything, right? It wasn't like, oh my gosh, we got to go 50 because we have a problem. It's like, yeah, let's catch up and move into this. So it's really all about cadence. And that's the whole big thing. We've gone from do we have cuts to what's the cadence of the cuts. So now we got a 50. So we probably look at one in November, 1 in December, that we will pull 1% out of it. And then probably next year you may have 1 a quarter, looking at how data's going to go, looking at how the economy is going to go. They make a move, we wait and see. We make a move, we wait and see. Because I think they want to make sure that if you think about Fed gymnastics, they stuck the landing. Now they don't want to screw it up.
Well, and then it comes back to, as you mentioned, earnings. We're going to start getting those numbers in a few weeks here where they start to come out fast and furious. How do you think they're going to look? And I find it interesting, you still like, for example, a couple of the chip names. So I guess what do you think we're going to hear broadly, and then what do you think we're going to hear from some of those chip makers?
Sure. I think broadly, earnings are going to be good. And also forecast earnings are going to be good. Remember, you're moving, and particularly when you think about not the S&P 500. If you take a look at the Mag 7, let's move it out to the 493, and then also small caps. So you're going to begin to see earnings be good. You can see a lot of upside surprises. When we talk about the 2 companies that we brought up, ASML and AMD, when you talk about, I've always said in this part of the market, you want to buy chips on dips. Because this AI thing, it's not just AI, but it's AI plus H. It's AI plus a human. How do we increase labor productivity? How we drive profits going forward? So if companies are going to continue to drive profits going forward, they're going to impose and get AI into what they're doing. And you got to have chips. Right? And so that's like I said, chips on dips. We like ASML. That's one of the ones we've talked. They have a monopoly on extreme ultraviolet lasers. They got a 2-year backlog in some of their products. They're 40% of TSMC's capital expenditure. So you have one company that has this monopoly on the equipment that's necessary to build what drives everything forward. So we like them long term. And then we like AMD. And the reason why we like AMD is I always like a scrappy second place runner. You know, you want a company that they're trying to give. They're going to. They did the thing with Microsoft Azure, and I think they're going to move forward and really try to challenge NVIDIA. I mean, NVIDIA is certainly massively moving to the market, but I think you want to take a look at the second place guy who's trying to catch up, right? And so I think we like the idea that AMD is going to do that. Plus, all their legacy businesses are going to go good, and they're going to be moving forward in that. So we think they've got
some chips and dips. And
chips on dips.
And some second place runner. All right, thanks so much, Dryden. Good to see you. Thanks for coming in. Well, former President Donald Trump delivers his economic policy message in Georgia. The GOP nominee doubling down on his plan for tariffs if reelected as president.
If you don't make your product here, then you will have to pay a tariff, a very substantial tariff, when you send your product into the United States. China is right now building major auto plants in Mexico. Did you know that? They were going to start with me. I said, no, if you do them, I'm putting a 200% tariff on every car that comes.
Here with more Yahoo Finance's Ben Worschel, who watched that speech for us. So, Ben, what are some of the other takeaways here?
For sure, yeah. So it's only Tuesday, but believe it or not, there's been a whole lot of Trump tariff talk this week. Yesterday he was in Pennsylvania. Today he was in Georgia, and he did open up some new areas. You heard it in some in that clip. One element that I think is new this week from Trump is a real focus on specific companies, and that's obviously of interest to investors. Yesterday he talked about John Deere and saying not only would he do 200% tariffs, as you heard in that clip, on automakers, he would do 200% tariffs on John Deere products if they moved to Mexico. Today it was IBM and GE, the recently split up conglomerate. So he's talking more about specific companies as kind of a name and shame strategy to say, I will do tariffs directly on you, which I think we'll see if that's a trend that keeps going. Another bit this week was he talked more about doing it unilaterally. That's something you kind of have tended to hear from his aides or people that work for him or advisors over recent months. But he said this week, I don't need Congress to do this. I can do this on my own, which is true to some extent. It's especially true on places like China. It's much more complicated on Mexico because of USMCA. So he's sort of signaling that he's going to go right after specific companies and try to do it on his own. And this was part of an overall speech on his economic plan to bring manufacturing back. He talked a lot about carrots as well. So this was the stick to get companies back. And then he talked about some carrots like a corporate tax rate.
Ben, I'm curious, listen, you follow politics so closely. You'll hear about these polls, Ben, which show that Harris is really narrowing the gap on the economy with Trump, which is obviously so critical. I'm curious to get your take on why you think that is. Do you think it's because voters are hearing her economic policies and are swayed by them? Or is it more that, listen, there's just some big, powerful tailwinds, the stock market is working, inflation is cooling, and that's the reason? Or is it a bit of both?
Yeah, I think it's a bit of both, and I'll give you a couple more reasons there too. I mean, there is a real interesting trend in the polling that voters tend to separate her from Biden. Voters still really don't like Biden's economic policy, but they sort of view her as separate. So there is a sort of separation she's been able to do there, partly through these new policies that are a little bit different from Biden's, but not totally, and partly through just kind of who she is, that she's not Biden. Another one to bring it back to the tariff question, she has been hammering this really hard. Mark Cuban did a call today with reporters, mostly on tariffs. They call it a national sales tax. The stat they use is that it would cost an average family $4,000 a year, which is a real concrete number. So that it's unclear as sort of how much that's driving her economic growth in this, but that's another element of this as well that seems to be breaking through, at least to some extent.
All right, thank you, Ben. Appreciate it.
Thank you.
TikTok is shuttering its music streaming service beginning November 28th. This just 2 years after parent company ByteDance aimed to compete with the likes of Spotify and Apple Music. And Yahoo Finance's senior reporter Alexandra Canal joins us with more. Allie.
Hi, guys. Yeah, so November 28th is the day, and this really symbolizes a shift in strategy here for this company because it no longer wants to directly compete with those third-party music streamers like your Spotify's, Apple Music, Amazon Music. Instead, it wants to continue to collaborate with them, and that's partly exactly why we saw Spotify shares close higher today, up a little over 3% on the day. And because of this new collaboration that TikTok really wants to sort of emphasize here, the company is encouraging folks to utilize the Add to Music app feature. And this lets users save songs that they discover on TikTok to the music streamer that they so choose. And if you think about the trajectory of TikTok music, this is an experiment that really started back in 2019 when ByteDance's music streaming service Resso first debuted. And then in 2022, ByteDance initiated talks with music labels to really expand this service. Once those licensing agreements were signed, the platform officially relaunched under a new name, TikTok Music, in July 2023. But it was only available in certain markets, including Indonesia, Brazil, Australia, Mexico, and Singapore. But as we've been reporting, TikTok has found itself recently in some hot water when it comes to some of those labels. It wasn't too long ago that we saw that Universal Music Group TikTok feud dispute that led to artists like Taylor Swift, Drake, Adele off of the platform for quite a few months. It was eventually resolved in May. And then there's that overarching question that this app might cease to exist come January. There is that bipartisan battle going on. We did hear TikTok make some of those arguments, but if their verdict, if that comes in and the judge says no more TikTok, that's going to have ramifications across the industry.
Well, then the music thing will be a moot point at that at that stage. Thanks a lot, Ellie.
Of course.
Appreciate it. Well, coming up, KB Home out with its latest earnings. Shares are under pressure. We'll get you those numbers when Market Domination Overtime returns.
Shares of KB Home under pressure here, sliding more than 6% following its third quarter earnings. Let's get you those numbers. Q3 EPS 204 versus expectations of 206. So that is a miss on the bottom. Revenue 1.75 billion versus 1.73 billion. So beating on the top. Deliveries 3631 versus 3569. Full year housing revenue look like they're calling now for 6.85 to 6.95 billion. They had seen 6.7 billion to 6.9 billion. Worth keeping in mind, of course, this stock had been a monster. It was up about 40% this year heading into the print. It was up nearly 90% over the past 12 months.
Yeah, and it's interesting there that the stock is falling on that earnings miss, even with raising that full year housing revenue forecast. I did find that the commentary in the company's statement is not super positive. Jeffrey Mesger, the chairman and CEO, talked about net orders being flat with the year ago quarter. He also said there was variability in demand across the quarter. There was softening in late June through July as, quote, buyers continued to evaluate elevated mortgage interest rates and general economic concerns were rising. Now, he says orders did improve in August as we saw a little bit of moderation in those interest rates and that they're encouraged by that trend here. Still, it's something to keep an eye on. And the company also is increasing its investment, boosted investment in land acquisition and development by more than 50% year over year to almost $850 million. So if people are concerned about the bottom line, maybe they see that spending and they just want to keep a close eye on it.
Yeah, I reached out to Jay McCandless over at Wedbush. Jay covers the name. I wanted to check out his earnings preview. What Jay was telling his clients, he's neutral on KB Home. He was telling them, listen, in terms of broad themes to listen for, he was looking for any insight on obviously current demand trends, of course, but also whether or not the lower mortgage rates have reduced customers' desire for mortgage rate buy downs, other incentives. Any update he wanted to know on KB's share repurchase activities. Remember, conference call, by the way, starting shortly here at 5 p.m. Eastern, so some of those questions will be raised for sure.
Well, and there was a little bit on that repurchase, by the way. In the quarter, it sounds like they repurchased $150 million worth of stock, and they've bought about 5% of their shares since the start of the year. So that's
at least initially disappointing.
Yes, it looks that way. Well, it is Climate Week here in New York, that yearly event that brings together leaders from business, government, and civil society to drive climate action, happening at the same time the UN General Assembly, as well as the Concordia Conference. That brings together nonprofits, governments, and the private sector. And that's where I spoke with Mars Inc. CEO Paul Weyrauch. And we talked about sustainability. I asked him how he thinks about that for his company.
We get bang for the buck. It's an investment, and we will see positive impact through the way we run our business, through the talent we attract. And I think really if there was a message I could share, there is no trade-off between purpose and profit. There is no trade-off between sustainability and good business.
And it's interesting here because Mars is, of course, a privately held company controlled by the Mars family with some $50 billion in sales. And of course, it's set to get bigger with its $36 billion acquisition of Kellanova. It's awaiting approval and expects to close on that buy in the first half of next year. But if you look at the company's sustainability initiatives here, they first set out the plan to shrink their greenhouse gas emissions in a bigger sustainability plan back in 2015. Since then, they have cut those emissions by 16%, at the same time growing sales, sort of speaking to Weyrauch's point there. They've tied employee compensation to sustainability goals, and also those goals extend beyond the company itself to their supply chain, including in agriculture as well as customers. So that's just one example of the kind of thing we're hearing during Climate Week. But let's talk more about where the investment opportunities lie within sustainability. For that, let's bring in Trevor Allen. He's head of sustainability research at BNP Paribas. Trevor, thank you so much for being here. Appreciate it.
Thank you very much for having me today.
Well, I think we have to acknowledge first, Trevor, that even as this is a big topic of conversation here in New York during this Climate Week and sustainability is still very much a priority for some companies, that there has also been a backlash against it. So I wonder from your perspective if you are seeing as much interest from clients and as many sustainable investment opportunities out there in the past couple of years.
So far, we are absolutely seeing as much interest in the market. I think the difference here is we really need to start to depoliticize the issue. The reason that solar and wind have really become attractive, particularly for utilities, is that they're economically competitive with natural gas or with nuclear. And that's true whether we look at China, we look at Europe, or we look at the US. So I think the important part here is really understanding that in the US on July 4th at 1 p.m., when you're looking for a bit of relief from the heat, most places in the US, something like solar is going to be a very effective and cheap form of electricity to provide for that air conditioning. And likewise, when you move into a situation on December, when it's very cold and it's 7 p.m., you're very much going to be more likely to rely on natural gas or a nuclear source that is non-intermittent. So the important part here is that we're very much seeing opportunities as a portfolio approach. So we expect utilities to have nuclear, to have natural gas, but also to have wind and to also have solar.
And are you seeing the opportunities sort of evenly distributed globally, or are there some geographies where you're seeing more chances for investment than others?
Well, there's no doubt that on a pure scale basis, China is clearly the leader. China manufactures around 90% of the world's solar panels, and they've also installed 220 gigawatts of solar last year. They're going to install about the same this year. So you're looking at China having around 880 gigawatts of solar by the end of this year. That's significant. But we are seeing the numbers continuing to tick up both in Europe and in the US. So these are growing areas in terms of development. And certainly we would look more on the investment side of developing solar farms as being the more profitable venue or approach to go into the solar market rather than the manufacturing of the panels. So I think it's important to what part of the development process you're investing in that sense.
And I guess with farms, there are more opportunities across geographies as well. I mean, since you mentioned China, I have to ask about the China stimulus that was just announced as well.
Of course.
Is that going to give an extra lift to some of these types of investments that you're talking about there, whether it's solar panel manufacturing or, say, electric vehicles, for example?
So I think if we take the two separately, China has a nameplate capacity of around 900 gigawatts of solar panels that it can produce every year. The world cannot absorb 900 gigawatts of solar panels. So I think in China, we are looking for a bit of consolidation in the solar industry, particularly the companies that are making the new technology solar panels are likely going to be the winners there. But yes, today's stimulus is a step in that right direction. I think with the EV space in particular, once again, you're looking at consolidation. So one of the risks in China is oversupply. The more consolidation we see in those markets, the more strength we actually see out of the equity investment into those companies in particular. So that's something we were looking for on the back of the stimulus here. And the other part about the stimulus, it would be nice if this is another step in that stimulus pathway and not necessarily the end game.
Something else I want to ask you about, without getting too in the weeds here, Trevor, is that you guys sort of tried to update your framework about how you're evaluating these companies. You're looking at sustainability, of course, but you're also looking at some more quantitative metrics here. And again, without getting too wonky, if I'm an investor and I want to look for sustainable opportunities, what do I need to prioritize here?
I think one of the basic things is looking at what part of the economic cycle you're in. Some companies are more cyclical, some are more growth oriented. When you figure out what part of the economic growth that you're really going into, certain sectors are going to benefit from that. So I think it's worthwhile having a macro view of where you think you are in the economic cycle. So if you're in a buying phase, the growth companies certainly make a bit more sense. And it's a bit easier in terms of EVs and new energy to kind of fall into that growth area. But certainly if you're in a more defensive area, we found many opportunities in industrials and materials that offer companies that truly have sustainable goals, but are actually a more defensive place in that sense.
Trevor, thank you so much for taking the time. I appreciate it.
Thank you very much. Have a great evening.
You too.
Time now for What to Watch, sponsored by Tasty Trade. Starting off with earnings, Micron is going to be reporting results for the fourth quarter after the close. Analysts expect the company to report in-line results for Q4 and sales tailwinds as NVIDIA ramps up its H200 GPU production.
Moving over to housing, we'll get the reading on new home sales data for August. Economists forecast those sales to come in at 700,000. That's down from an annual pace of 739,000 new home sales in July. And it comes after last week's existing home sales fell unexpectedly, and the median price rose more than 3%. But as mortgage rates continue dropping, we could see a boost in sales going forward.
And finally, we get some more Fed commentary tomorrow from Fed Governor Adriana Kugler. This coming after Fed Governor Michelle Bowman spoke out on her dissenting vote today. Plus, yesterday's round of Fed commentary where Minneapolis Fed President Neil Kashkari said that the 50 basis point rate cut was the right decision in light of inflation progress.
And some late-breaking news here. Caroline Ellison has been sentenced to 24 months in prison for her role in the collapse of FTX. The judge saying that Ellison, of course, known as the former girlfriend of Sam Bankman-Fried, can serve in a minimum security facility here. As well as being SBF's girlfriend, she was the head of FTX's investment arm, which was Alameda Research, which was really at the center of a lot of the allegations about FTX, that they were using customer cash in order to cover some of their trades at Alameda.
Yeah, reporters also noting this means that other cooperators, they point out, so Gary Wang, Nishad Singh, will likely receive jail time. They note Ellison has to forfeit about $11 billion. And the judge pointing out here, they note that this case is serious. There cannot be a get out of jail free card. So sentenced to 24 months.
Yes, so the latest in that saga. And as you mentioned, there are still other hearings here that are pending. So we'll keep people posted on those. In the meantime, that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned. Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The market extending its record run, both the Dow and the S&P 500 squeaking out gains in today's session. We're looking at the top movers of the day and what drove the action. Plus, one of the key drivers of inflation in recent years, auto insurance. We're taking a deeper dive into the auto industry with the CEO of Hagerty and what cars Gen Zers are looking to buy. Plus, the hottest deals in media are for sports rights. One of the companies at the center of it all is on the verge of inking a new deal. The CEO of All Elite Wrestling is here. Car insurance premiums skyrocketing in the first half of 2024, up 15% from the first half of 2023. That's according to a report by Insurify. And by the end of 2024, coverage is expected to rise even further. Here to talk more about the recent surge and the broader auto industry, we're bringing in McKeel Hagerty, Chairman and CEO of Hagerty, and Yahoo Finance's Senior Autos reporter, Braz Sumarania. McKeel, welcome to the program. Listen, I want to start, McKeel, you know the classic car space backwards and forwards. You also know the auto insurance market. And so I want to get your thoughts there. The Fed has started easing. I'm just curious what you think the impact of that is on the auto insurance space, the ripple effects.
Well, it's certainly been getting a lot of attention in the last really 2 years. And you had this compounding effect of both COVID claims coming through, kind of 2 years coming through in 1 year, inflation, rising interest rates, higher costs in almost every dimension of auto repair, which made for some pretty tough years for the auto insurance industry. And obviously that ends up becoming reflected in rates. It's a regulated business. So insurance companies have to manage their rates to make sure that they have premiums adequate to pay their claims. What we're learning, though, is that I think a lot of the rate increases on the general auto insurance market in the U.S. are starting to level off. So I don't see them coming down anytime soon, but we're beginning to see that leveling starting to happen, which is good news for everybody.
Hey, McKeel, Pross here. So, we spoke about a month or two ago at Pebble Beach talking about classic cars, that alternative asset space there. We were kind of talking about general trends here in the space, and we kind of saw that auction values coming down a little bit, but there's still healthy demand there. What are you seeing there in that space, both for enthusiasts but also investors?
Well, it's a little bit like the financial world, right? There's a rebalancing of the fun car world, the enthusiast car world. If you will, the generational shift is really upon us. For many years, that baby boomer generation, the largest collector generation of all time, they drove the collecting market all the way up from 50s cars, post-war cars, pre-war cars. They were firmly in control of what people were buying, selling, the values of vintage cars. And people kept asking us, I know we talked about it when we had a chance to get together, what does the next generation think? Is the next generation into cars at all? And of course, a lot of the data post the financial crisis suggested that the next generation is in fact not that into cars. But the data is really suggesting otherwise, and it is a real rebalancing taking place where vintage cars, the great ones especially, will continue to hold their value, but they may not be increasing in the way that they were in the previous years. But we recently did a big survey of multiple generations, and what was so interesting is to see that the Gen Zers, the very generation that everybody said was not into cars at all, they're quite into cars. They're interested in cars. Over 60% suggested that they're interested in owning cars. Over 75% saying they like to drive. And we consider that to be pretty good news when you think about the future of how people might collect. You start with what you drive every day. And then when you make a little bit more money, you start owning the cars that you really want to have. So again, rebalancing taking place. Some of the older generation cars, those cars that were focused on by previous generations, are kind of leveling off. And the new hot stuff is cars from the 80s, 90s, and early 2000s, all performance cars. So it's fun to watch.
McKeel, let me ask you, is there one car out there that is sort of considered the holy grail for collectors?
Well, look, across decades, the Ferrari brand has been a car that just always seems to be top of mind for everybody. And that's been really holding true for a long time. And even during that financial crisis, that big dip that I mentioned, 14 years ago, Ferrari prices, vintage Ferraris especially, still held strong. And of course, the modern Ferrari brand continues to, I think, bolster that. I mean, they went public, their support of F1. The modern Ferrari cars are just in huge demand. They're building more of them each and every day. So they've been driving a lot. But the brand that we really like to look at and that has been really on the rise the most in the last decade is Porsche, and specifically Porsche 911s of virtually every generation of 911. They're fun to drive. They're not always as valuable as, say, some of the Ferraris that we talked about, that I just mentioned. The holiest of all grails is really the 1962 Ferrari 250 GTO. But Ferraris, Porsches, and then, of course, with some of the next generation, you start seeing some of the other some of the other marks start to come on board. So BMWs are very popular with the next generation. Some of the Japanese sports cars are starting to become more popular with the next generation of collectors. So like I said, it's a rebalancing. There's still this love of cars across generations. And, we kind of have a front row seat here at Hagerty.
Hey, Mikhail, so, that really caught my eye with the Gen Z population. We've been told they don't like cars, they don't like driving, they like Uber. They don't even have licenses. So I'm a little bit, I was surprised that you mentioned some cars there, makes like Porsche, which of course I love, but I want to know, what's your advice to a younger collector? What do you think they should do if they want to get into this world of classic car collecting?
Well, there's so many ways that you can learn about cars now that didn't exist when I was getting into it as a kid. And it's hard to explain to people why they like them. They just simply like them. We call them the different on-ramps into the car world. And the first on-ramp for many of the younger generation are, in fact, video games. The two major console video games, Gran Turismo on Sony PlayStation, Forza on Xbox. It's not just about racing. It's not just about playing a game. There's tremendous amounts of information. There's a whole community of people that are into cars that play those games. And that's the way a lot of the next generation are starting to get into them. Of course, there's so many great online resources, but we really recommend that you go out to some car events. What makes the car world unusual, as opposed to a lot of other things, even very expensive things that people buy, is that car people gather. They go to car shows, there are car events everywhere. There's some new car events that are out there, a couple of that we're participating in, one that is a series of car shows that are called Radwood events. Those are cars that celebrate cars from the 80s and 90s, those cars that the next generation are into. We recommend you go, talk to the owners, talk about the cars that you might want to own, ask what they are like to drive. Are they difficult to repair? Can you find parts? All of those things you might need to know if you're going to buy one of the vintage cars. And then, the best thing you can do is just get your hands on the wheel. You were talking about data, next generation not being interested in cars. So much of that conclusion was drawn, again, after the financial crisis, when there was a whole cohort of people who were struggling to actually make enough money to have cars. It's not whether they like them, it's just, the job market wasn't very good. Well, fast forward 15 years, it's quite a different story, and more people can afford fun cars to be able to go out there and buy them, own them, collect them, even race them. So there are just more resources than ever out there. But, my view always, when you're buying a fun car, spend the money that you can afford to spend, buy something that you really like. Don't worry about whether that value is going to go up very much. Just have fun driving it, and then you can go from there.
Mikhail, listening to you describe those events, I think Praz just found his next story. And I'm going to insist on tagging along. Mikhail, thank you so much for joining the show today. Really appreciate it.
We'll see you at the next event somewhere.
The Dow and S&P 500 picking up another record close. Stocks rising after China unveils a stimulus package. Here with the trading day takeaways is Yahoo Finance's Josh Schaefer. Josh.
Hey, Josh. Yeah, so the S&P 500 and the Dow Jones hitting a fresh record high, but that came after some relatively negative news in the economy. So consumer confidence unexpectedly fell in September. We saw stocks dip a little bit on this, but they shook that off. And I think part of the reason why, Josh, is when you really look at the consumer confidence chart here, economists like to point out, we've just been in a range. People just don't feel that good about the economy, no matter what economists will say about the strength of the economy. And it really hasn't changed that much for 2 years now. And so in large part, even when you get a relatively decent dip down here like we had this month, economists sort of reason, okay, we're just not getting back to this point right now. We're not going to get overly worried about one release. That was one of the key takeaways. But economists did point out sort of the broad takeaway from this one was it's people feeling a little bit worse about the labor market is what's driving consumer confidence down right now, and that might be slightly a concern moving forward.
I thought also some of the just demographics levels we hit there, Josh. I mean, I saw strategists pointing out if you looked at a key 35 to 54, that declined to a level we haven't seen to the depths of the COVID lockdown.
Right,
I mean,
it's interesting, and you wonder what's going on for those people in maybe that sector of the labor market, right? I think that would be an interesting thing to look at. A final thing here, we're going to get in this chart with Julie in a little bit, but this was sort of the labor market differential chart. This is people saying jobs are plentiful, minus jobs are hard to get. That's coming down. This is how we know. This graph just explains to us that it's how people feel about the labor market and if they're able to find that next job. That's what's bringing down confidence. But should note, this came out before the Fed rate cut decision. Would be interesting to hear how people feel and if they feel like maybe the labor market will be helped by those rate cuts. We'll find out next month. All right, Josh, our other takeaway. China stocks took off today off the stimulus package. It was the thing to watch in markets. So I'm going to pull up KWEB here, which is the China Internet ETF. And one thing I want to point out, so you see this massive surge today, right? Up 10%. But I thought Jeffrey Kleintop at Schwab put good perspective on this. We've seen this a lot with China stocks. You can look year to date, right? KWEB is a great way to look at this. If you take a look year to date, we had a big push in May. It was the time to buy China stocks. China stocks are undervalued. They're going to rally. And it just didn't actually happen, and then we came all the way back down and you had this push. So he's sort of saying, okay, this is positive news. What does it actually mean for consumers in China? I don't know if we know yet, and maybe I'm a wait and see until I'm a buyer here, if depending on sort of what stocks you're looking at, right?
Yeah, I saw some smart commentary too, folks pointing out that the central issue for China remains the same, which is just this imbalance, overinvestment in real estate, underconsumption by consumers. So they were kind of questioning, does this address the core foundational issues?
And that impacts a lot of the key stocks that we look at, right? When you think about an Alibaba, a Pinduoduo, JD.com, those are stocks that are heavily levered to the consumer. I mean, I just showed you that chart with KWEB. It's the same thing when you look at a Pinduoduo, right? Really popped in May, positive for the year, but then it's been drawn down and it's that consumer. And so it seems like this is a positive news story today. What does it mean for the economy in 6 months? Feels like a looming question that hopefully we'll find out a little bit more about.
All right, Joshua, thank you. And stick around, more asking for a trend right on the other side. The number of consumers who view jobs as hard to get is growing, and the number of consumers who view jobs as plentiful is shrinking. Yahoo Finance's Julie Hyman joins me now with a closer look.
Yeah, we got this data as part of the consumer confidence report that came out today that overall showed that biggest drop in 3 years' time and really put a little bit of uneasiness underneath market action today. Wells Fargo out with a note highlighting the labor differential number in particular here. As Josh mentioned, jobs plentiful minus jobs hard to get, or at least how people are perceiving those two metrics. So now it's at 12.6%, but obviously the trajectory has been downward in that number as we've seen sort of this realignment of the job market. Now, it might be a little tricky to see, but you saw that number dip into the negative during the brief 2020 pandemic recession. You also saw the metric go into the negative during the financial crisis, and that recession, it didn't go negative sort of until the end of the 01 into 02 recession. So it's not necessarily a recession indicator here. And indeed, the folks at Wells Fargo say, yes, we have seen this measure declining here, but they said, quote, we're hesitant to put too much weight on this data given broader confidence measures have remained depressed this cycle despite resilient spending habits of households. In other words, confidence and this measure and spending don't necessarily always match. And indeed, when we earlier talked to Dryden Pence about this, investor Dryden Pence, he said really this is a sign of normalization in the labor market.
Well, we had this moment where, a year or so ago, we were looking at, 2 jobs for every person looking, right? And so now the job market has come back into more balance. And I think that's one of the things that's allowing the Fed to do some of the movement that they're doing, because they don't want to get in these rage spirals and, these real peaks. So as, certain markets are saying jobs aren't quite as plentiful as they were, and, it's a little bit harder. That means that we're moving to a balanced job market.
So maybe not yet a cause for alarm, Josh, but definitely something to watch here.
Sure will. Julie, thanks so much. Well, everyone has a money story that we're not so proud of, and Yahoo Finance's newest podcast, Living Not So Fabulously, dives into these tales, helping you to become more grounded with your money by learning from others' journeys, without shame, without judgment. Join husbands and hosts David and John Ottenschneider every Wednesday at 12 p.m. Eastern. Stick around. Much more Ask for a Trend still to come. Professional wrestling has come a long way since its humble beginnings in gymnasiums and VFW halls. Media rights deals go for billions of dollars now. Apparel sales alone approaching $500 million a year. And it's even become an incubator, of course, for some of Hollywood's biggest and most profitable stars. But after decades of WWE dominance, there's a new kid on the block shaking things up. And joining us now is Tony Khan, All Elite Wrestling CEO. Tony, great to see you.
Thanks, Josh. Thanks for having me on.
Let's start off, Tony, kind of big picture. Maybe many viewers don't all know. All Elite Wrestling, how do you all compare and contrast with the big rival? Well, WWE.
AEW, we believe we are where the best wrestle. AEW, we've got the top stars, and we have wrestling every week on TBS on Wednesday nights and Fridays and Saturdays on TNT. We have got some of the most exciting pro wrestlers, and we work with companies all over the world. So we bring in the top international stars from Mexico, Japan, all over the world. And we set the world record for ticket sales last year in the UK. We sold 81,000 tickets at Wembley Stadium, and it's the world record for wrestling ticket sales. We've got a great partnership in the UK with ITV, so we have the biggest TV audience of any wrestling company in the UK. And like I said, our focus is on growing the business here on TBS and TNT every week, but also international. And I think we've got the best wrestlers right now in AEW.
And who's your demo, Tony? Is the fan different than WWE?
They're both very young demos. Both companies have young demos. AEW fans tend to be slightly younger, and there's some...
Why is that? Why do you think?
It's hard to say. I mean, WWE's got a very established, large audience, and as an established league with over 60 years of history, I think it makes sense why they would have a big audience. AEW now, we're approaching our 5-year anniversary. Next Wednesday, we'll celebrate the 5-year anniversary. This is kind of the biggest 2 weeks of television for AEW we do all year. We've got AEW Grand Slam coming up tomorrow, Wednesday Night Dynamite, live on TBS. The biggest episode of Dynamite all year here in New York at Arthur Ashe Stadium. And then coming up next week is the 5-year anniversary show in Pittsburgh. We'll celebrate 5 years of AEW on Turner on TBS next Wednesday. So every Wednesdays, we have been the #1 show on cable. During basketball season, the NBA is often the #1 show on cable, and we're #2. But right now, we've had a lot of top finishes. Last week, I think Mr. Trump's appearance, the President Trump on Gutfeld, was the only show that ranked ahead of AEW on the Wednesday night rankings. So it's interesting to see, because I think, like, for us, typically finishing 1 or 2 on Wednesdays and also having a top show on each Friday and Saturday, where, you know, we were very competitive this past weekend with, like, NASCAR, for example, on USA. We finished 4th in our time slot on TNT, behind only college football on ESPN, ESPN2, and NASCAR. And there's been a lot of Saturdays where we finished 1st in the time slot among all the sports, and even beat UFC prelims at times on Saturday.
Let me ask you this, Tony. So lots of viewership, lots of excitement, right? I did see these reports say you and Warner Brothers Discovery are going to continue to do business together. Want to make sure I have this right. New deal could pay you around $170 million per year, Tony. You want to add any color and commentary there?
Well, I can't comment to the specifics, but I can tell you that we've got great discussions, and the goal and the intent and the plan for all of us, and I think we can say with 100% certainty, AEW is going to be on TBS and TNT for a very long time to come. I can tell you with a really certainty. We've got a great partnership with Warner Brothers Discovery. Mr. Zasloff, David Zasloff, has been a huge supporter of AEW, and I've spent a lot of time with him, and he believes in what we're doing. He believes in growing AEW on TBS and TNT, and I think there's potential for AEW on new Warner Brothers Discovery platforms to grow the business even more. It's no secret that WBD has a top streaming platform in Max that's really grown, and they've built a great sustainable streaming platform there, and I think that's a great strategy for us to try to focus on, and that's someplace I'd love to be for AEW as Max.
Let me get you out of here quickly. Your dad, of course, Shahid Khan, owner of the Jacksonville Jaguars. Between wrestling and NFL, Tony, you're kind of where media investors want to be. I mean, it's about sports rights.
Absolutely. I think we work in some of the top leagues with AEW, the NFL, Jacksonville Jaguars, and Fulham in the Premier League, which is obviously a top international sports league and also has really built its U.S. audience over the years. So I think we have a big focus on sports media rights. I'm also the owner and chairman of True Media Networks, the largest sports analytics engineering firm in the country, working with the vast majority of Major League Baseball teams and a lot of the top media partners like ESPN, where they've got a couple thousand people that use True Media every day. And I think sports analytics, sports media rights, there's so many great opportunities still to grow in the sports space. And AEW is a great example where we think there's huge opportunities to continue growing AEW after just 5 years and what we've already achieved.
Quickly, we're about the same age, roughly. Your favorite wrestler growing up, who was it?
Ricky the Dragon Steamboat and Sting.
Oh, yeah, there it is. Tony, great to see you, brother. Thank you so much for joining us.
Thank you.
Appreciate it. That is a wrap on today's Asking for a Trend. Have a great night.